Welcome back to Intermediate Accounting, Cost Accounting, Managerial Accounting. Today we take up two more chapters in the book, Chapter 3, which is Cost, Volume, Profit Analysis, and Chapter 4, which is Job Costing. Cost, Volume, Profit, also known as CVP for short, analysis distinguishes fixed costs from variable costs and examines how the total revenues, total costs, and operating income change with changes in the number of units sold, changes in the selling price, and variable costs per unit, of course, as the fixed costs themselves change. So these interrelationships are then explored throughout the chapter. CVP analysis helps management determine what we call the break-even point, the point at which the profit margin begins to overcome the cost of the product and the company begins to earn a profit or make money. Recognizing uncertainty, managers will test these relationships based on the different assumptions that go into making them to see what difference it makes when assumptions change. The level of fixed and variable costs in a company also determines a degree of risk, and we'll examine that closely as well, taking into account these various risk and profit trade-offs. Finally, cost variable profit analysis can be easily adapted to multi-product and multi-cost drivers, that is, activities that drive costs, and these situations apply to both service and nonprofit corporations as well as to manufacturing firms. So this is our very first and simplest model of cost analysis, and it is probably the most widely practiced because it is indeed the oldest. Next we turn to Chapter 4, Job Costing, which is one of a pair involving jobs, and then later on we'll look at what's called process costing. Managers use two basic kinds of costing systems to assign cost to products and services. Those, of course, are job costing and process costing. These systems of most companies combine elements of both systems. Companies use job costing systems to determine the cost of direct materials, direct labor, and overhead costs required to complete individual jobs. So the job is the unit of production. Obviously, in contrast, the process would be producing a single product without termination, as in an assembly line. Let's take, for example, bottled water products. Water's poured into bottles and the bottles are all identical. This would be then a process, which we'll look at later. To provide timely information about job costing, the management uses normal costing systems and actual material and labor costs. But as the jobs are being done, the labor cost has to be estimated based on previous experience. Then it can be adjusted later on for changes in the prices of both materials and labor. And there are various ways of estimating and allowing for these, all of them based on careful assumptions, which should be spelled out to the management at the time they're made. At the end of each month, entries are made in the ledger to account for the costs and revenues of all jobs worked on during that month. The use of estimates to allocate cost to overhead results in different amounts of total overhead costs incurred and total overhead costs allocated at the end of the year. Accounting systems determine the difference between overhead cost incurred and overhead cost allocated, that is an estimate, and make end-of-the-year adjustments to account for the difference. So these two chapters, again, have significant new vocabulary. I'd like you to focus particularly on that. I've assigned a modest number of problems to work out so that you can master the concepts in here and see how they work in the accounting recording system of debits and credits. I hope you have a good study time with this. Make sure to allocate sufficient time. Note that there is a first exam coming up in 2 weeks from now. Thank you very much.